How's it going, everyone? I want to welcome you to a brand new lecture in the 2025 Trading Protocol series. Now, in this lecture, we're going to discuss the final element to the lower time frame protocol, which is identifying whether time meets price. And so without further ado, let's get into today's lecture. So if we just recap what we've done so far, we've identified a low resistance liquidity run environment utilizing our environment selection protocol. We've identified the order flow is either bullish or bearish on the higher time frame. If we assume order flow is bullish for simplicity, we've identified a draw on liquidity and price is retraced into a point of interest. Once this occurs, we've now dropped to the lower time frame. Once we drop to the lower time frame, the first thing we wait for is for a change in the state of delivery. So breaker formation, inverse fair value gap, or inverse fair value gap plus breaker formation, which will look something like this. We've identified SMT. The minimum time cycle we're going to utilize is 3 minutes. So a 3-minute cycle SMT at the smart money reversal to validate this market maker buy model. And then finally, we need to identify whether time meets price. Now, in order to do this, we're going to utilize what we call times of interest, or TOI. These times of interest are from 45 to 15. For example, 9:45 to 10:15, 10:45 to 11:15, and so on. They occur every hour from 45 to 15. Now, within these times of interest, we want to see one of two delivery programs. Either we want to see price produce a reversal, or we want to see price produce an expansion. If either of these delivery programs occur, we can say that time meets price. Why? Because if price produces a reversal or an expansion within our macro window, price is doing what it's supposed to do when it's supposed to do it, and therefore we say that time meets price. Now, in order to showcase this, I'm going to show two different examples. So let's assume that the smart money reversal is of course the lowest low within this market maker buy model, this low here. We're going to assume that the smart money reversal occurs within our time of interest. Let's say this is, for example, 9:45 to 10:15, and this reversal occurs around 9:50, for example, within the macro window, within the time of interest. As soon as CST occurs and we have SMT, we can say that time meets price, and we can execute any points inside or outside the macro window. And so this is the reversal scenario, and more specifically, the rule is if the SMR occurs inside the TOI, so if the smart money reversal occurs inside the time of interest, time meets price, and this means we can execute inside and outside our TOI. So we can execute within the TOI and we can execute outside the TOI. Why? Because time already meets price. Now, the second scenario is that the reversal occurs before the macro window, meaning if this is our TOI, we can see that the smart money reversal occurred before the TOI. What do we need to do in this example? Well, what we need to do is wait for the next time of interest. Why? Well, because if the reversal's already in, the next delivery function that should occur is expansion. Meaning, if the smart money reversal occurs outside the time of interest, we need to wait for the next time of interest to execute. And so if the SMR occurs outside the TOI, time does not meet price. Why? Well, because price hasn't produced a reversal or expansion inside the macro window. Therefore, we need to execute inside the TOI, so inside the macro window, in order for time to meet price. Why? Well, because if the reversal's in, what can we anticipate? Expansion, which is the second delivery function that we want to see. And so basically we've got two different rules to identify whether time meets price. If the SMR occurs inside the TOI, time meets price, and therefore we can execute inside and outside the TOI. This is the reversal scenario. The expansion scenario is if the SMR occurs outside the TOI, time does not meet price, and therefore we need to execute inside the TOI in order for time to meet price. Why? Because price will likely produce that expansion. Now, I've now added a small adjustment to this rule here. If we just read it, if the SMR occurs outside the TOI, time does not meet price, therefore we need to execute inside the TOI, and I've added 3 minutes before, i.e. XX42, in order for time to meet price. So what I mean by this is although we have to wait for the next time of interest to execute, what we can do is if there's a setup 3 minutes before, XX42 or XX43, XX44, we can take the trades. Why? Well, because what can occur is the macro window will arrive and price will just distribute straight towards the drawn liquidity at 45. And so what we can do is we can position ourselves 3 minutes before, assuming there's a setup, in order to basically avoid this scenario occurring where price will just expand without us. And therefore, you can execute at the very earliest if the SMR occurs outside the macro window at XX42, meaning at the 42nd minute of any hour. Now, this does not mean that you should take a trade at XX42. What this means is if there's a setup at XX42, meaning you've had an entry invalidation and all higher time frame and lower time frame components are met, then you're allowed to execute the earliest at XX42. But this does not mean to place the trade at XX42. We're just allowing ourselves a 3-minute buffer because if the time of interest is going to distribute without us, we've missed the move. And so executing 3 minutes before is going to allow us to basically mitigate this issue and align ourselves with this low resistance liquidity run. And so just to summarize, the way we identify where the time meets price is using macro windows from 45 to 15. For example, 9:45 to 10:15, 10:45 to 11:15, and so on. In these times of interest, we either want to see a reversal or expansion occur. If the SMR produces a reversal inside the time of interest, time meets price, and therefore we can execute inside and outside the time of interest. And for the expansion scenario, if the smart money reversal occurs outside the time of interest, time does not meet price, and therefore we need to execute inside the TOI at the very minimum 3 minutes before at XX42 in order for time to meet price, in order to produce that expansion towards the drawn liquidity. And so these are the rules that we're going to utilize to identify where the time meets price. So what we're now going to do is we're going to look at some trades that I've taken applying these two rules in order to identify where the time meets price. And so this is a market maker buy model. And as we can see, price has now reached our point of interest. Drawn liquidity was higher. I'm now annotating a bullish breaker formation, which is this price range here. We've also got this SMT here, 10-minute cycle, which validates the market maker model, minimum 3 minutes. If we look down here, 157, 145 is here. And so we can see that the reversal has occurred within the time of interest. And so already I can identify where the time meets price. And so as soon as CST and SMT is confirmed, I can look for an entry, invalidation, and a target. And then what we see, buy side of the curve being delivered into our objective. And so this is the reversal scenario where the SMR occurs inside the macro window. If we look at another example, we've got market maker sell model, expansion, retracement, expansion, drawn liquidity is lower, point of interest is this imbalance, drops a lower time frame. What we can see is you have this big SMT here. And so this here would be now the smart money reversal. Even though it's lower than this high here, because as SMT, we can treat this high as well as this high as the smart money reversal. And we can see 9:45 to 10:15, I've got annotated. Why? Well, because if the reversal occurs within this time period, I can say that time meets price, and therefore I can trade inside and outside the macro window. And what we see is price delivers the sell side of the curve, produces that distribution lower. We're now coming up to the next macro window, 10:45, and then we get that distribution lower into the drawn liquidity. As this example, 9:45 to 10:15, produce the reversal, and therefore we can say that time meets price. Now looking at another market maker sell model, order flows bearish, expansion, retracement, expansion. We've now retraced higher into a point of interest, anticipating a expansion leg lower now. Look at the bottom right, 10:33. I'm now waiting for 10:45. There we go, waiting for 10:45 to 11:15. 10:45 arrives. I'm now looking for SMT and a change in the state of delivery. Once I get that, I take the shorts. Why? Well, because the smart money reversal, which is this high here, formed between 10:45 to 11:15. And so I can say that time meets price. And therefore, I can take the trades, assuming we have SMT and CSD. And as soon as time aligns with price, I can look for an entry and invalidation level. Anticipating higher prices, drawn liquidity is higher. Look at the bottom right, 232. Waiting for 245. Price is now retracing to POI. I'm now waiting for a change in the state of delivery. Price displaces higher, producing SMT. You can see here I've got annotated 245 as well as 242. And so now I've executed the trades 2 minutes before the macro window, 145 to 315. Why? Well, because if the smart reversal occurs outside the macro window, we can anticipate 145 producing that distribution. And if we just play price out, that's what occurs. We can see price produces that distribution leg higher. And so I'll basically position myself ahead of that distribution because price can move without me. And so in order to mitigate that missed trades, we position ourselves a couple minutes before the macro window and maximum 3 minutes. If we look at another example, looking for a market maker sell model, expansion, retracement, expansion, drop to lower time frame. We can see the time down here, 9:41. This is now 9:45, this line here. Just to show you, 9:45. SMT, CSD, now just waiting for time to align with price. And so it's now 9:41, so the next minute, 9:42, I'm allowed to take the trades. So you pay attention to the bottom right, 9:42, I've entered short. Why? Well, because 9:45 is likely to distribute. And if you just take a look, we can see that 9:45 produces that distribution lower into our targets. And so this is a trade where I executed 3 minutes before the macro window or time of interest. Why? Anticipating 9:45 to distribute. Another example here, market maker sell model, expansion, retracement, expansion. As you can see, I've got here waiting for 9:45. It's now 9:37. We can see a change in the state of delivery. We had this bearish order block formation. Notice 9:41. So if we have SMT, which we do, and we have CSD, which we do, bearish order block formation, then as long as time aligns with price, when's that occur? At 9:42. Why? Because 9:45 will distribute. I can take the trades. So if you pay attention, this candle here, this wick, is 9:42. So executed as soon as 9:42 began, with my stop above the smart reversal. Why? Well, because 9:45 can distribute, which is what we see here. Price is distributed lower into our target. And so again, if the SMR occurs outside the macro window, the earliest we can execute is at 42, 9:42, 10:42, depending on what the macro window is that we're looking at. And this is a live example of me actually applying that in real time. CSD occurs, SMT occurs, executes exactly at 9:42. Why? Because 9:45 will now likely distribute because the smart reversal is already in. If we look at one final trade, what we can see, anticipating lower prices, expansion, retracement, expansion. We can see I've got 9:45 annotated here. Why? Well, because if the smart reversal occurs inside the macro window, after CSD and SMT, time aligns with price, we can see we've got a change in the state of delivery. This would be, for example, a 1 minute bearish breaker. We're now on the 15 seconds, so retrace into the breaker, type 2 validation, anticipating a high formation. And so I can execute now at any moment, assuming I get a setup. And so there's the execution, 10:13. Why? Well, because this is the smart reversal, original consolidation, left side of the curve, smart reversal, right side of the curve. And because it occurs inside the macro window, I can execute outside the macro window. And then we can see the price distributes into our targets, previous day low, as well as our drawn liquidity being 19,950. And so just to summarize, if the SMR occurs inside the time of interest, time meets price, and so we can execute inside and outside the TOI. That's rule number 1. Rule number 2, if the SMR occurs outside the TOI, time does not meet price, and therefore we need to wait for the next time of interest to execute. And the earliest we can execute is at 42. Why? Well, because we're anticipating 45 distributing. And so we can execute 3 minutes before. So these are the 2 rules we're going to utilize to identify whether time meets price. If you look at any of my trades, you'll see that these are the rules that I apply every single time. And this keeps me out of bad trades because I'm waiting for the highest probability trades to occur. When do they occur? When time aligns with price. So that brings us to the end of today's lecture on time. These 2 rules, apply them to the charts. It will save you from taking bad trades, and it will ensure that you're only focusing on high probability trade setups. And so I hope you found some value. And with that, I'll see you in the next lecture. Be safe.